Hello and welcome to Making Sense of Financial Statements, presented on behalf of the Victorian Council of Social Services as part of the Clearinghouse Rural and Regional Training Program. My name is Michael McGann and I'm a Senior Project Manager for Matrix on Board, a consultancy company that works exclusively with non-profit organisations, building capacity in financial management, management support and governance. My background is in financial services, where I've spent the past 5 years working with small to medium-sized financial planning firms to help them achieve their goals and objectives. I hold a Diploma of Financial Services and a Master's in Organisation Dynamics, and at Matrix I work with CEOs and boards of not-for-profit organisations to help them to develop their management capacity through business and strategic planning. I'd like to welcome you to these training programs, which will introduce you to financial statements, some common accounting methods, and the importance of this information for boards when they make decisions regarding the current and future capability of your organisation. Accompanying this presentation is a participant manual, which can be downloaded from this site. If you have previously attended one of the workshops that were conducted, it is important to note that the presentation has been altered in structure to accommodate the short video format. However, the content is unchanged and can be found in your participant manual. This is the first of 5 information programs designed to help people prepare, read and understand financial statements. In this first program, I'm going to discuss the board and the importance of financial reports to the board. In program 2, we'll look at the most common types of reports used and the differences between them. And in program 3, I'll provide an overview of a cash accounting versus accrual accounting and the impact on revenue and expenditure. In program 4, we'll make sense of the budget and how to build a budget. And in program 5, we'll explore financial ratio analysis. So let's begin. In this first session, we are going to look at the role of boards within organisations. What are their responsibilities and obligations, and how should they use financial reports? There are 5 main questions that all boards should know about their financial position. These are: do we have the right resources to deliver the programs we have committed to deliver? What are our outstanding liabilities and what are the risks? What will our future look like in terms of a store of resources? Are we effectively managing our financial processes? Do we have the right team in place to do what we say we do? Section 558G of the Companies Act imposes one of the most stringent duties on directors, and importantly, there is no distinction between commercial and non-profit directors, nor incorporated associations and companies limited by guarantee. Section 558G requires a director to prevent the company trading while it is insolvent or becoming insolvent, and requires directors to avoid incurring further debts when the company is insolvent. The implication of Section 558G is that a director must be sufficiently informed about the company's financial state to know when it is approaching insolvency. In this context, prevent means doing everything reasonable to stop the company incurring debt. For example, arguing against it at a board meeting, having the dissent recorded, and even resigning from the board. If the company insists on incurring the debt and is then placed into liquidation, the directors who are responsible could be prosecuted by ASIC, with civil penalties up to $200,000 for each of the directors, except those who could show that they had acted responsibly. The board is required to conduct appropriate due diligence of its financial records. As already stated, every board member has the same level of responsibility as each other for the financial position of the organisation. Therefore, every board member must be able to read, understand and vote to approve the budget. For the board to meet their legal obligations, they require bookkeepers and accountants to be providing them with up-to-date and accurate information that allows them to carry out their functions as a board. The primary sources of information to allow the board to make effective financial decisions are the balance sheet and the cash flow report, which we will look at in a later presentation. So what do financial reports tell the board? Financial reports contain the information that the Board of Management consider when making decisions which have financial implications. This requires them having up-to-date, comprehensible information which will inform those decisions. The better the information in the reports, the better the decisions. The essentials of accurate financial reporting tell us whether the organisation is using the funds for their intended purpose, is applying due diligence, that is it behaving correctly, the organisation has a strategy in place, and manages its operational risks and measures organisational performance. The financial information that is required to support good governance is income earned during a period, expenditure incurred during a period, the planned income and expenditure in a period, the value of the assets held by the organisation at a point in time, the value of liabilities owned by the organisation at a point in time, the accumulated value of what is owned by the members or owners of the organisation since it began. Boards are responsible for ensuring the sustainability of the organisation, and to do this they must have a strategy or a plan for how they will achieve this. Timely and accurate reporting of the organisation's financial position is essential for the board to achieve this function. As I mentioned earlier, every board member must be able to read and understand the budget. And this includes being able to understand the comparison between the budget and the actuals. So what exactly do I mean when I say the comparison of the budget to the actuals? Well, the budget is the costing of the business plan. For example, a prediction of the aspirations, dreams and fears of the financial future of the organisation. The actuals are how the reality is tracking against the predictions. Accurate financial reporting also allows the board to assess and manage risk within the organisation. Risk management is the process of managing an organisation's potential exposure to liabilities, preventing them, or providing funds to meet the liability if it occurs. I'm sure you can think of areas of risk for your organisation. Some include risk to reputation, fraud and theft, compliance with government grant conditions, loss of investments, inaccurate computer records, negligence in delivery of services, and/or professional negligence. There are numerous ways to manage risk. These include insurance, internal policies and procedures, and monitoring through reporting. All financial management reports can and should be used by boards to minimise their risk and meet their legal obligations. So, in summary, we've now explained the responsibilities of the board, the type of information they require, and how this information is used to support the ongoing ability to deliver services to clients. In the next presentation, we'll look at the most common reports that are used and the differences between them.